The Apartment Gurus podcast is brought to you by Greenlight Equity Group, an apartment acquisitions and holdings firm co-founded by Carl York and Tate Siemer, host of this show. We offer you the opportunity to be an owner of cash-flowing, wealth-growing apartments without the headaches of being a landlord. These assets are recession-resistant, risk-mitigated, offer significant tax advantages, and are a great alternative to the stock market. Ready to check it out? Go to www.investwithgreenlight.com today to book a personal consultation with Carl or Tate. Again, that's investwithgreenlight.com. We look forward to meeting you. Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back to another episode of the Apartment Gurus podcast. And, it's the end of the year here as we're currently recording. So you'll probably be listening to this first month or two of the year here. And hopefully your 2023 is off to a great start in the multifamily space and your investing space. And it's our mission here at the Apartment Gurus to be a part of that, to enhance your success, to enhance your progress, and to help out however we can. One of the very direct ways we can do that for you is I'm actually available for free, no strings attached consultations with you guys as the audience. And you can just simply go to investwithgreenlight.com and get my Calendly link. And I love just to talk business and talk investing with really anybody that's aspiring or currently investing, and just love to be a contribution and be a help. So, and speaking of that, today's guest, Mr. Shane Carter, I'm super excited to have on the show. I think you guys are going to get a lot out of this. Shane started out where so many of us started out, including myself, in the single family space. And then he got into construction and new development, land entitlement type work, and now is in the multifamily space. And he's zooming into us from New Hampshire, right, Shane?
That's right.
Yeah, that's where you are.
Yeah.
So sunny, tropical New Hampshire right now.
That's right.
As we have this mammoth winter storm about to hit us. So, and Shane's company, by the way, it's Hampshire Capital. So you can go to www.hampshire.capital.com. Is that correct, Shane?
No, it's just Hampshire.capital.
Hampshire.capital. Okay, great. That's what it says. So Joey likes that name, my dog. He's enthusiastic about that. You can hear him in the background.
Thanks, Joey.
Thanks, Joey. Right? Yeah, he knows what's up.
Right.
So he's not really a barker. He usually only barks when there's someone at the door. So maybe we got somebody here, but nonetheless, Shane, welcome to the show. Really excited to have you and excited to learn more about your path to success and to where you are today.
Yeah. Thanks, Tate. Appreciate it. Honored to be here. Love your podcast. And hopefully we can bring some value to your listeners here today.
Yeah, that's perfect. So starting out in single family, Shane, did you start out locally? Where did you start your single family ventures?
Yeah. So, I guess really rewinding to my ultimate first start was actually when I was living out in Colorado.
Okay.
I was living just west of Boulder, and I was sort of, examining where I wanted to take my life at that moment in time, and literally, kind of bought a self-help kind of, it was like a no money down system. I think it was Carlton Sheets, right? That's how old I am. It's old school stuff. And so I studied that course, and I flipped actually a couple of contracts in Colorado, kind of bit the bug, moved back to New England, worked on Cape Cod down in Massachusetts for a while, and then, finally back up here in New Hampshire is where I settled. Really I have I guess a classic self-made man story, I like to call it, right? Where, I started flipping contracts, and then I started flipping single family homes, and sort of really loved that I could make those chunks of cash more quickly than I could just working at a job. So I haven't had a job since, right? It's been over 20 years now, 24 years actually. And that was a great journey for me at that moment as a sort of young man in my 20s. And what I found when I was flipping homes is that I really loved the process of construction. I just loved the process of creation. I really got into construction. And so I started a general contracting firm, and we built single family homes. We built sustainable green homes, did a lot of geothermal, a lot of solar. Nice. Did a lot of high-end residential homes, multi-million-dollar homes on the oceans and lakes, and here in New Hampshire and in Massachusetts. And, then I got into small community development, doing, small subdivisions of homes, like a 3-lot subdivision, then a 7 or 10-lot subdivision, and so on, and grew from there. And then I got into land development and entitlement, and sort of taking it cradle to grave, getting the raw land entitled, getting it approved, getting the roads put in, building the homes. In that entire process, did some condo developments, mixed use developments, et cetera. So that's been my journey on that sort of what I call those are transactional cash businesses, right? So that's where I made transactional income. Yeah. And I always took that income that I made and invested it in multifamily assets. Almost exclusively value add multifamily assets. And it was always sort of concurrent with the capital that I had, right? So my first asset I bought, some 17, 18 years ago now was a 4-unit, right? And then I bought a 6-unit, and then I bought an 8-unit, and then I bought a 20-unit and a 60-unit, and so on and so forth. And I really didn't have capital partners. I just kind of used my own money and had my construction company do the work, right? And sort of recycled some capital that way. And then, once I got into larger, 100, 120, 140, 180 plus unit deals, I started to bring in just a handful of investors, maybe one group, maybe two groups, mostly high net worth, other operators, locally, other investors, or, family office guys that I came to know around here. And so that's sort of how I grew organically here in New Hampshire, and then really sold all those assets off between 2016 and 18. And, for those of us that kind of came through the crash, it sort of felt like that was the top of the market, right? It felt It felt like, now's a good time to get liquid and wait for it all to happen again. Of course, now in retrospect, in hindsight, we know that everything's doubled and doubled again since then, right? But look, I had, I was buying things at 20 grand a door or less. So when I was selling them at, 70, 80 grand a door, it was all good. I was pretty pleased with selling those assets in that time frame. But what I did, Tate, is I kind of took a look at, okay, I took a look at what I had done in the past, and then looked at, all right, well, I've done that, and I don't want to keep doing the same thing. I want to grow. I want to expand. What's next for me? What am I going to do next? And that's when I really started looking at growth markets in the South and sort of understanding how I could intelligently invest that way. And so Hampshire Capital's story is really one that we created the firm in 2020, late in 2020. My business partner, Nick Bouquet, was selling his partnership interests in a LIHTC firm, low income housing tax credit. And he was looking to move into market rate housing. So we developed our investment thesis, which we'll talk about, but really started the genesis of the company at that time, and sort of hit the ground running. Had our first acquisitions Q1 of 21. And since that time, we've bought 2,000 doors, about 225 million in assets, and really looking to double that again in 23.
I'm sorry, how many doors did you say?
2,000.
So since 2020, you've acquired 2,000 doors.
Yep. Technically since March 16th of 2021. Yeah.
Wow. That was our first acquisition. Man, yeah, that is absolutely fantastic growth. Good for you. Really good stuff. Just out of curiosity, you have a grasp on what that portfolio is worth at this point?
Yeah, it's about 225 million.
225. Wow. Fantastic job. That's really good success in a very short period of time. So you dumped your properties in 2016 to 18. And you're right, man. I mean, back then, not only did a lot of us think that the top of the cycle was there, but I mean, we were being told that, right, by industry experts and financial, gurus and economists that are paid to know a lot about this stuff. And little did we know that the growth would continue. We'd have a black swan event like COVID happened. We would have literally trillions of dollars injected into the economy, or hundreds of whatever it ended up being, and that there'd be a wealth of capital on the market in addition to very low interest rates for the next few years after that. So did you guys just get tired of watching the success of everybody else and decided to jump back in 2020 essentially?
Yeah, in 2020, obviously everybody, we all kind of freaked out in March, right? In April. Yeah. And by May, I was ready to rock and roll again. I had a very positive outlook. I could sort of see through, some of the market conditions that were there. And I knew that it would be a good time to buy, right? I knew that with the cheap capital and sort of where we sat was going to be a good time to buy. It still took me, almost a year to get our first acquisition because we're conservative. We're cautious. We don't just buy anything. We have very strict underwriting and location guidelines that we adhere to very strictly. Mm-hmm. And so, it took us a little while to find that right first deal or two. But then when we did, sort of the system just kicked in and started to roll.
How did you come up with you mentioned your investment thesis earlier and your buy criteria, your location specifics? How did you construct all those?
So, Nick and I sat down and we really, first for me anyway, personally, I wanted to ask myself, look, is multifamily the right place for me to invest? Mm-hmm. Right. And I wanted to be thoughtful about it because, just because that's been your history, just because that's your background, is that truly the best investment vehicle? Is that really the right place for me to invest? I've always been sort of, enamored with self-storage, right? And sort of all of these other shiny object syndromes. And look, there's great asset classes out there, right? I mean, industrial, we looked at industrial. We really looked at all the asset classes and thought, what is going to be the right asset class? We started there. And so for us, and for me specifically, it was that, look, all of those other asset classes, medical office, self-storage, industrial, it's tough to think right now, those could be replaced someday, but they could, right? Yeah. Societal needs can change. And we've seen it in our lifetimes. And what was favorable once can fall out of favor, right? Sort of the blockbuster theory. And although I think those asset classes are very, very safe, especially for another decade or so, not sure what's going to happen beyond that. But if you look back 1,000 years ago, there were people who needed homes and there were people who lived in multifamily residences, right? Yep. And there were other people who owned those. And that's going to be true 1,000 years from now. And so we know that that's an evergreen asset class. And so couple that with the fact that I do have a lot of experience in it, made that a no-brainer thesis. But to get to your exact question and your point, we really looked at, okay, so, if we want to look at the next 10 to 20 years that, that we're going to be investing in these types of assets, most of our business plans are, 3 to 5 year, 5 to 7 year, or 7 to 10 year, depending on the grade of the asset, whether it's, C class, B class value add, or stabilized A class. And so we really had to drill into demographics. Where are jobs moving? Where are people moving? Where is the growth happening in the United States? None of this is rocket science, right? Everybody knows where those markets are, but we keyed in specifically on states that had fundamentally advantageous laws relative to landlord-tenant law, and that were also in the path of progress and have great growth trajectories. So for us, it's North Carolina, South Carolina, Florida, Texas. That's it. Those are the only places we will invest. Yeah. And in those areas, only the major MSAs where there's, aggregated 1 million plus populations. And the reason for that, Tate, is liquidity. We want to be able to trade assets. our investment thesis is all about velocity of capital, not necessarily just buy and hold for a lifetime. And, when I die, my kids will inherit this apartment building, but rather how do we create the most advantageous growth metrics for our own equity to multiply and recycle that equity and use 1031 exchanges and recycle that capital and grow it continually at the fastest rate that we can come up with. And so, some of that's value, most of that's value add, but we also do have, a part of our portfolio that we're allocating to more stabilized assets just to balance that risk reward quotient. But they're all in those areas. And then what we do once we get to the right MSA, Tate, we drill down to the neighborhood level, right? So, pick a major MSA. Let's say Dallas, for example, right? Everybody knows Dallas is a great place. It's booming. It's an amazing city. We just bought an asset there last month. But is every neighborhood in Dallas a good place to invest? Absolutely not, right? You really need to do your due diligence. You need to know the local landscape. You need to know what those neighborhood demographics are. And within the MSA of Dallas, you've got some population, some neighborhoods that have pop growth that is 20, 22, 25% over the next 5 years, per CoStar, Yardi Matrix, right? And then other ones that have negative growth. So we're very, very cautious about the neighborhoods within the MSAs that we buy in. One of our slogans is we buy neighborhoods first and assets second. And so that's really, that's really the main metric. And then I'll just share another one quick with you, which is that when we look at a value add asset, one of the key metrics we look at is where does it sit in the comp set, right? So once we've checked the box that it's in a good neighborhood, it's got good demographics, it's got good household income, good population growth, relatively low crime, considering the MSA, overarching crime map, and all that checks out. But then we look at, okay, can we fundamentally add value to this asset? And so we try to pick assets that are in that sort of below the 50th percentile, right? But hopefully closer to that 25th percentile in the comp set. And then we look to bring that asset into the 75th to maybe 85th percentile. So we never want to be a market leader. We never want to be the top rent in our market. We always want to draft what others are doing, let somebody else push the envelope on where they can raise rents. And we're just going to come in and do the same program and just be less expensive and sit behind them. And so when we look at our value add program, we look at, can we raise the net operating income of the asset by 50% in 3 years or less? And if we can do that, then we know that we're adding value. And if we can't, we're likely just going to pass on that asset and never really drill into it.
That's the NOI that you're measuring there. Is that correct?
Correct. That's correct.
Okay. That's okay. So that all sounds great. I think what the listener might be asking is, how do you find those deals? What's your secret in terms of Dallas, North Carolina, South Carolina, Texas, Florida, they're all on lots of people's maps as far as great markets to buy in. And they've been highly competitive here in the recent years. I'm sure you look through a lot of deals, but what's your game as far as producing the kind of deal flow that it takes to find those properties?
That is a great question. And you're right. That is likely something that everybody has on their mind. And so our story is really one of understanding that this is a relationship business. Yeah. Understanding that partnerships are key, and understanding that relationships are key. So how do a couple of guys from New Hampshire start buying assets in, all those places we just mentioned? It's really relationships. And so we really nurture and cultivate our brokerage relationships. A lot of these guys we work with closely, I consider them friends, right? And so that's important. And then, once you transact and once you get a deal done in a market, and what, especially some of the deals we've done, which were larger, 50, 70, $80 million deals, people notice and they say, oh, wow, okay, these guys can close, they can execute, they know what they're doing. And, you kind of raise up a few rungs in the ladder from there. But how we did it was it's all through broker relationships and obviously having local partnerships, right? And having local people on the ground. We now have employees as well on the payroll in those locations, but we, we started with local JVs, local relationships.
Yeah.
And, this is a team sport. And so we closed a lot of those big deals also by having good relationships with family office partners and guys that could come in and help with KP sponsorship, help with some liquidity. And that's really the name of the game. It's a team sport.
Yeah. Very well said. You started to answer one of my questions, which is, $50 to $80 million deals require a team, usually, particularly in the way of capital and the equity piece. You mentioned family office type sources for those pieces, both in the way of sponsorship and capital. Just again, kind of the tough question, right? Like, how do you find those? How do you go out and establish those relationships with family offices? And was it through equity brokers? Was it debt equity guys? How did you find those guys?
Yeah. So ours it's an ever evolving process, right? It's literally something I work on every single day. Everybody talks about it's deals and money, right? Those are the two most important things. And so my partner, Nick, focuses on the deals and I focus on the money. And it's absolutely something I work on and cultivate every single day and have been doing this for years and years and years. Mm-hmm. And so it really is a combination, Tate, of some equity brokers. Absolutely. We have a great network of equity brokers that we work with. And again, just like with, the brokers on the asset side, we cultivate those relationships. We care about them. We touch base with them and vice versa. And then, again, we solved some of those deals too with just, co-GPs, right? Where with other groups that would come in and would co-sponsor and raise some capital, bring some capital. And then we also have relationships with capital raisers, relationships with broker dealers, Series 6 guys that, are registered agents to raise capital. Mm-hmm. And so it's a combination of all those, as well as, having, a network of family office folks and ultra high net worth individuals and groups like that can bring capital to the table, bring liquidity, even co-sponsor, debt and loan products as needed. And we also have relationships with, like an IRA custodians, right? And QIs for 1031s, and really nurturing all different facets of capital that's out there to put ourselves in the most advantageous position to solve that cap stack on any given deal. And we haven't launched it quite yet, but we are in the back and forth with our attorneys right now to set up our first fund. And so we're going to have our first fund roll out here in the next, probably the next month or two, when we get the docs all finalized. And that's going to be a fun process for us to get, fund 1 done, and then fund 2 and fund 3, and then really proceed through that way. And that's sort of our next trajectory and our next path. But yeah, I hope that helps. It really is just a network game of just continuously networking and trying to provide value to others and naturally getting that value given back.
Well, one big takeaway here for me, and hopefully for the listeners, is, a couple things. Number one is just the nature of this business being relational, long game, relational business, right? As opposed to the single family world, which is essentially transactional in nature. You're doing one-off deals with somebody, and then you're off to do another deal with somebody else, as opposed to the multifamily space where you're establishing authentic, like, connected relationships with brokers and with capital sources, with equity brokers, with co-GPs. You mentioned IRA custodians. Like, building these relationships is where it's at. And the other thing that you mentioned was that you work on this every day. And I think that is a massive, massive takeaway for you listeners to be thinking about. And yes, a lot of us, not myself, but a lot of us in the space have W-2 jobs and are either maybe transitioning away from a W-2 job or and otherwise have time limitations. And that's great. But if you can make 5 phone calls a day, 10 phone calls a day, and it's daily, right? Like it's something that you don't miss. It's something that you get done every single day. That's going to be a great foundation and a great start for what you're doing. And the other thing I'd mention that you didn't mention much, Shane, but that I'm sure is a huge part of your game is just follow up, like world-class follow up, like finding out what kind of, finding out about, like, say you're working with a broker in Dallas, like you want to know how many kids they have, what their kids do. Are they they play soccer? Do they, where do they vacation? What kind of things do they like to do for fun? And, even things like birthdays, like keeping track of all that. And your broker relations game, in my opinion, requires as much of a CRM effort as your capital raising game does. And you want to have, you want to have a database that has all your brokers in it, and where you're tracking your follow-up, you're tracking your contact, you're not letting things slip through the cracks. How often do you touch base with brokers on, say a broker maybe you're not doing a current deal with, but just kind of following up and saying hi? How often do you do that?
It depends. It's usually sort of once every other week, right? Unless we have something to work on or something active. And really just to give you context, what that call sounds like is, first, look, you hit the nail on the head. You're absolutely right. I mean, what you just shared, Tate, is gold. That is absolutely the ticket. That's what you have to do in this business. And, you have to be real, be authentic, be who you are, and actually care about the relationships, because this is a long-term game. This is a very, very small world. It's a very, very small network. When you're talking about large commercial real estate and multifamily, there's a huge amount of opportunity, but really the players, especially as you get into those higher those larger MSAs, it's very small, and everybody talks and everybody knows who's who, right? And so being real, being authentic, and actually caring about those relationships goes a long way. But how that call sounds is just, hey, Tate, just wanted to check in with you. We don't have anything that we're actively working on right now, but here's some of the opportunities that we have said no to in the past 2 weeks since we chatted. Just wanted to let you know that, we constantly see deals and screen them. As you know, we say no to 90+%, 95% of every deal we look at. We're only letting the really good ones come by. And the next time you hear from me, hopefully it's going to be that we actually got one of those 5% to land, and we're super excited about it, because we know that you and your network of capital really has a very specific buy box, and we're very attuned to that. And we want to make sure that we're only going to deliver that which your groups want to invest in.
Yeah.
Right. And that's
great script. Great follow-up.
And then, of course, you absolutely throw in, the personal. I take notes on everything personal. With somebody mentions offhand that, they're taking their son to a bar mitzvah, or it's their, I make note of that. How was that? How did it go? Everybody had fun. That's amazing. And, making sure that you're actually nurturing those relationships and caring about the people you're doing business with, right? That's something that's important. That's part of our culture at our company. We care about our residents. We care about investors. We care about all of our connections, because that's ultimately, the know, like, trust thing that everybody talks about. Well, the one in the middle is like, you have to actually be liked. And the way to do that is to actually like others and be genuinely interested in them.
Yeah. Yeah. There's no substitute for authenticity in any part of the human being game. Like, as humans, we love being around people that are authentic. We love talking to people that are genuine, that show genuine interest in us, that are clearly not self-focused and not self-centered, but are other focused and other centered. And the more authentic that you are with that and with those relationships, certainly the deeper the bonds, the more top of mind you're going to be when opportunities do come up. And this, the game of being top of mind is big in this business. Brokers get calls all the time, and they get a lot of tire kickers. They get a lot of people that are just pounding the pavement for deals. And if you come at them from a place of like, hey, just really want to get to know you and get connected and find out what it is that you do, and like ultimately, like, how can I help you, right? Like, you want to be a value add person to whoever you're working with, and being a great buyer and a buyer that transacts and does what he or she says he's going to do is gold to a broker. So and to an equity broker as well. Like those relationships are key, and really can't say enough about that, the whole interpersonal game of this business. And if you are not a people person, so to speak, first of all, I challenge you to really examine that and see if that's really the case. But if it's really the case, you need a partner, man. You need to have somebody on your team, in your corner, that is very much a people person, that is good at going out and establishing these connections and these relationships, because it's where everything happens is inside of these relationships in this business. And you guys have obviously done a great job with that. Where are my notes here? I've got so many notes. I'm on multiple pages now, Shane. So, so your portfolio is fantastic so far. Where are you guys headed? Are you guys goal centered? Are you, do you have a vision that you've written for the future, or where do you want to see this go from here?
Yeah, absolutely. I don't think that I strongly believe in visions, and I strongly believe in setting those goals, big picture, as big of a picture as you can make it. And then working your way back into what those shorter term goals should be to be able to achieve that long-term vision. And I think it might've been Tony Robbins who said, we all greatly overestimate what we can do in a year, but greatly underestimate what we can do in 10 years. Right. Yeah. And so our 10-year goal as a company is to be in the 5 billion assets under management range. And frankly, I'm hoping that we can maybe even do that in 5, right? And prove Tony Robbins right. But we're a big fan of EOS traction. If your listeners haven't read that book and you're in a company or starting a company, it's absolutely critical. We believe in it. It's an entrepreneurial operating system, right? I mean, it literally is about goal setting and how to run a company very efficiently. So we're big on that, and we're implementing that on a daily, weekly, quarterly basis. And so, that's our 10-year goal. Our short-term 1-year goal for next year is to add another 2,000 units or about 250 million in AUM next year, which is sort of double what we've done over the last 2 years, right? Yeah. And really to get to a billion in assets under management by the end of 2024. That's our goal. Awesome. And then we can really scale from there. We've taken our construction management vertical in-house, not in small part due to my background. We'd started working with other third-party GCs and I just couldn't stand it. I couldn't take, not having that as a control mechanism, right? So it's not a profit center. It's just all about control, speed, and efficiency. Yep. And our goal is, big picture to, within the next 12 to 18 months. So, by Q2 of 24 to have property management in-house as well as a vertical. We are tracking to try to accomplish that by the end of 23, again, to sort of over improve on our goals. But I think that's going to be important. Same thing. It's not a profit center, right? It's not a high profit business. It's just control and speed of execution. And most importantly, controlling the culture, right? So we have a culture at our company, and we take a lot of diligence in cultivating it with our staff, with our folks, and with each other. And that obviously flows out into all of our relationships. But that culture really ultimately needs to hit the property level. It needs to hit the site staff. It needs to hit the residents. And when you have third-party property management, sometimes that culture is not necessarily a match for your company culture, right? And so having an ownership mentality and managing an asset like an owner would is sometimes something that a third-party PM firm can't do or doesn't do as well as you would like. So that's on our radar as well, to make sure that we control that cultural aspect of who we are and how we operate.
Yeah. Talk a few questions here, but talk a little bit about your culture. I think this is something that doesn't get talked about very often on the podcast, and yet is so important. It's important to us at Greenlight. We have a very succinctly defined, carefully defined culture here. But talk about yours and what that consists of and why it's important.
Yeah. So we list this right on our website, right? It's important, I think, to have a mission and to have what we call guiding principles. And so we have guiding principles, and we list them all out. I think there's 7 or 8 of them. I'm sorry, I can't, list them off on the top of my head, but they essentially define how we operate as a business and what those key things are. And then, of course, integrity is extremely, high up there, and open communications but how do we, it's really a guidebook of how do you conduct yourself every day? How do you conduct yourself in every single relationship you have? And when things get hard and you have difficult decisions to make, you have to have something that is sort of your guardrails of, what is the right thing to do in this situation? And there's our residents to consider, and there's our investors to consider, and then perhaps our own company and culture as the in sort of last place. But when priorities are clear, decision making is easy. I love that phrase. That's a borrowed phrase. Yeah. And so when you have very, very, very clear priorities, the decision making tree is super simple, and you just go and you execute, and you can execute with speed, which is important in this business. So our culture, is about openness, inclusiveness. We have profit sharing for every single employee, and we always will. We are in the process of understanding and laying out a company, almost like a 401k match, right? But it's a equity match. So if employees want to invest equity in any assets, there's a company match for that, to match their equity investing in assets alongside of us. We're creating a separate employee, fund or pool for that. And then finally, we're in discussions with a couple of different entities that have really amazing, brilliant concepts relative to allowing residents at the property level to allocate a portion of their rent or invest a portion of their rent into the equity in the asset.
Wow.
And to actually grow their equity in the asset as they're living in the unit. And so obviously that creates, buy-in, and less turnover and all the things that help you as an ownership. But we are actually fundamentally helping our residents as well invest and grow their money in an asset that they already live in and in a place they already love to call home. And so that's really one of the key elements of our, ESG philosophy. Everybody talks about ESG and, environmental, social and governance, but we really try to live it. And it's not just to try to attract that capital that has the mandate to invest in ESG initiatives, but because we actually believe that that's the right way to run a business. And that's the right way to look, what we do is powerful, right? We own residences, we own people's homes, and we manage them. And that is a huge responsibility. That is a fundamental right and a fundamental need in society. It's to provide housing, to provide safe, affordable, quality, clean housing. And that's what we do. In fact, we improve every asset we buy, and we take that very seriously. So, the environmental part, I just talked a little bit about social. We have an asset in Houston that we own where there's a daycare program, an after-school program, and it's free. We don't charge for it at all. All the residents get it for free. We allocate the space in the clubhouse. There's a third-party vendor that comes in. They get paid. They're a nonprofit, but they get paid, but we don't get paid as the property owner. And that's just straight a benefit, a social benefit for our residents. And we try to do that at every single asset.
Yeah, that's amazing. I've never heard of offering residents the ability to invest in the asset. That's in 190 episodes of this show and my 5 years of experience in the business. Like, I've never heard of that. That's very unique. Very
It's a great
original
concept though, right?
Yeah. I mean, it's fantastic.
If we can actually make this work, retention is going to be amazing, right?
And retention
also,
is key. Retention's so key in this business. Yeah.
Yeah, so key. So anyway, that's one of the things we're working on for our social initiatives and our assets.
That's awesome. Last question, and it's maybe not a simple one, but how have you changed your underwriting and your strategy in the last, say, 10 months as this market has changed so much?
Yeah, no, that's a great question. So we're cautiously optimistic about where we sit, but we're extremely diligent in our underwriting. We do not, we've always been extremely conservative. And so in these times, we're just even more conservative. And, honestly, what we do is we go back and we poll and have those open dialogues again on a daily, weekly basis with our capital firms, our capital partners, family office groups, and say, what do you guys want? What are you seeing? What do you want? How are you looking at things? And some of it is a yield on cost and understanding, that we're in a raised cap rate environment, so that going in cap rate and that yield on cost, there needs to be a spread, and that we really need to focus on two things right now. Number one is the basis. How do you know that you're buying the asset at a good basis? Yeah. That is the number one thing that we focus on after the neighborhood and the rent comp analysis and all that, is we focus on the basis. And we have all kinds of resources that we pull from to understand, are we getting this at a good basis in this environment? And I think that's the key. We're in a higher raised interest rate environment. There's the potential to get assets for a lower purchase price per door, per unit, however you want to look at it. But how do you prove that? How do you know for a fact that you're getting it at a good basis? Because that's an important story to tell right now. That's an important story to tell your capital partners, your investors, and to know that, ultimately 23 interest rates are going to stay high. They're going to stay elevated, but in 24, 25, at some point, they're going to come down, right? Yeah. And when they come down, you're going to have cap rate compression again. You're going to see all the liquidity flow back into the market. And liquidity is actually what drives cap rates up or down, not necessarily interest rates. I think that's a relationship that Dr. Peter Linneman taught me, and I believe in it 100%. It's actually market liquidity that dictates cap rates. So when the liquidity flows back in and we have a cap rate compression, and that price per door obviously then goes up, well, we're going to look like we were geniuses because we paid close attention to how we bought in this market relative to the basis. The second one we really look at is, again, is it off market? Sort of what's the story behind it? And whenever possible, can we assume fixed rate debt? Can we place fixed rate debt? There's even a thesis of placing, like a Freddie floater or a variable rate debt product where, if you're going to hold it for 3 to 5 years and you believe that the interest rates are going to come down, maybe you get an arbitrage by, having a floating product where the rate floats down as interest rates, float down, but you keep your underwriting fixed at that top level analysis for conservatism. You got to buy rate caps. So there's a lot to consider there, but debt and how you place debt in this market and assuming fixed debt, even if it's 45, 50% LTV, I think that's more important than anything else, because you're essentially setting yourself up for success because you've acquired a debt product that is below what the prevailing rates are in today's environment.
And there are opportunities out there, on market and off market opportunities for assuming fixed rate debt. And look, if you are setting yourself up to ride it out, so to speak, through the economic downturn and back into the environment that Shane was just referring to, where interest rates do start coming back down, cap rates do start compressing again. If you're able to get your properties to that period of time, like Shane said, you're going to be looking really good. You're going to be looking like a genius, because you bought right in this market. And that's why people talk about this particular kind of market being so rife with opportunity. And it's it's really like the whole idea of fortunes are made in economic downturns. That's so true in this climate with multifamily, but all the things that Shane said are so key about buying right, underwriting well, drilling down on your numbers, drilling down on the market, getting the debt right, getting all those pieces in place so that you can wait it out and be solvent and be good in the meantime. So Shane, if listeners want to reach out to you, learn more about Hampshire Capital, learn more about what you're doing, what's the best way for people to reach you?
Yeah, absolutely. So our website is just hampshire.capital. Yeah. Absolutely. Check us out there. We're revamping our website here next month. There's going to be, ebooks and all sorts of videos and things for folks to grab there. And then, all the socials, Facebook, LinkedIn, Instagram, etc. Shane Carter, NH. You can find me there. I love to connect with people. Happy to be a resource and help anyone out there. This is a team sport, and I like to help first and give first.
Yeah. Can tell. I mean, somebody who's had the success that you've had in the short period of time that you've had it, you got to be a value add guy, and you're bringing value to, just think about all the lives that you've affected by all the success that you've had, your residents, your investors, your brokers, like you're having a massive impact, Shane, on your sphere of influence around you. So I bet that feels pretty good.
It's an absolute honor, and I take it real seriously. But it's an honor to do so.
It is. It is a privilege and an honor to have the responsibility of having other people's well-being in your hands. Whether that's your residents, your investors, and all the other people that you touch in the business. So, well, Shane, this has been super enlightening, and it's just great to get to share some space with you and learn from all of the success that you've had. And I sure wish you just massive success moving forward. And if there's ever anything we can do at Greenlight to help you, please let me know. And we'll have you back on the show in a year and talk about that next $250 million that you just got.
Yeah, that's right. Well, my pleasure. Thanks, Tate. I really appreciate it. It's been great spending time with you too.
Yeah, likewise. And listeners, always great to spend time with you. You're the reason why we do this. And Shane and I showed up this morning to record this because you're there listening and learning and taking notes. And this is the kind of thing you need to be doing to sharpen your saw, but you need to use the saw too. And I'll just remind you guys of that it's all about action. It's all about those. We talked about 5 calls a day, 10 calls a day, whether that's brokers, investors, people that can really elevate you and elevate your business and move things along. So by all means, be taking that action and continue to feed that specialized knowledge through podcasts like this and books and all those conferences, all those things. But, somebody like Shane didn't get to where he is without doing all of the above, right? It's a multi-pronged attack on your success. So with that, Shane, thanks again, man. Really appreciate you being on the show.
My pleasure. We'll see you then.
Yeah. And then listeners, thank you. We love you guys. We'll see you on the next episode of the Apartment Gurus. Take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.